Well, hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B, and today we're going to be talking about capital investment analysis. And throughout today's lecture, we're going to be talking about capital investment decisions. Capital investments, as you know, is planning for fixed assets, property, plant, and equipment. Long term, think long term when we're talking about capital investment analysis. Think, capital, you know, funds, investment, we're purchasing property, plant, and equipment. And analysis, we're going to strategize that process of purchasing property, plant, and equipment. And throughout today's lecture, we'll bring up a couple of examples, and we'll also discuss financial strategies that have to deal with how we raise capital, how we use capital in making decisions. Right? That's what this course has always been about, is decision making from a manager's perspective in accounting. So before we jump into today's content and today's lecture, I do want to touch on a couple of key things. We are currently in the second to last week of this course. Today we are covering chapter 26. Since we're in the second to last week of the course, that means that you have your chapter 26 quiz. After your chapter 26 quiz that you'll accomplish this week, in the next week, which is going to be the last week of the course, we'll meet as we normally do on Monday evening here on WebEx. We'll discuss chapters 27 and 28, which are the last two chapters of the book. They're very, very short. We'll discuss a couple of key concepts. And for those of you who are graduating seniors, I will be reaching out to you this week to validate that that is indeed the case. And if that is indeed the case, which for those of you, I do have your names of those of you who are graduating this semester, I will be reaching out to you and requesting that you take the final exam next week, in addition to completing the two assignments. Sorry, you don't get off the hook that easily. So be on the lookout from an email from me this week if you're a graduating senior. And I'll be requesting that you take the final exam next week. For those of you who are not graduating, your exam will be during the regularly scheduled final exam week, although it's available now. So if you really wanted to get a head start on the final exam, it is available. It's open. It's available. You can start it now if you want to. Just make sure you do the save and close, don't do save and submit until you're ready, of course. So I just wanted to throw that out there. So what does that mean? You got chapter 26 quiz due this Sunday night. Next week you'll have chapter 27 homework assignment, chapter 28 discussion, something like that. I forget what it is. Yep, chapter 27 homework assignment, chapter 28 discussion next week. And for those of you who are graduating, you'll also have the final exam that week. The drone, yes, please.
Is there a chapter 27 and 28 in the book? Because I didn't see it there.
Yeah, there is. So it's this the version of this book I think is the 20 something edition. It might be the newer edition than the one that you have. But don't worry too much about it because the content is all the same. Um, what we're going to cover this for today might be slightly different than what your book has. Your book might be a little bit longer in the terms of the chapter, but it'll have content from 27 and 28. So what I'm trying to get at is you might be using the version before the earlier version of the book, which is fine. There's nothing wrong with that. It's the same book. It's just that the authors broke out a couple of different chapters and they made them a little bit shorter, but it's all the same content. And to answer your question, Thedron, as long as you go through the lecture and the PowerPoint presentations, you're not going to have any trouble. And to access the homework, do as you normally do. Just select the homework 27, 28, very, very easy. You'll be all right. Thanks for raising that question. Okay, any other questions before we get started? Good? All right, let's rock and roll. Okay, from the beginning. Here we go. So, as I mentioned, the idea of making investments into the company using capital meaning funds, is we are purchasing property, plant, and equipment, which is fixed assets. In this process, management develops a budget. The budget is called a capital budget, and it is used to tell management or guide management on the decision-making process of purchasing property, plant, or equipment, also known as fixed assets. So in this decision-making process, there are two methods that, I'll say primary methods, or groups of methods that management uses. One's called methods that do not use present values and ones that do. When we talk about present value, which is a term that we'll be discussing today, you want to think about it as being the value of a dollar and when that value of a dollar is evaluated. In other words, there's an old saying that says a dollar today is worth more than a dollar tomorrow. The reason why that is true is because a dollar today can be invested. A dollar today can be put into savings. A dollar today can be utilized and invested. That is the concept of the present value of money. We'll talk about that. There are a couple of a couple of methods that do not use present value of money. One is called the average rate of return method. It's exactly as it sounds. If you're looking at multiple investments or multiple projects or multiple options to purchase property, plant, equipment, you'll average the return on those investments and make a decision to purchase property, plant, equipment that way. The other non-present value method is called the cash payback method. That is a very straightforward method. What it means is it is how long it will take you to recover or recoup your initial investment. That's what cash payback means. How quickly you'll get paid back, right? And then there are a couple of methods that use present value. One is called the net present value method. That is the sum of all present values through a series of cash flows. We'll talk about it. And the other is called the internal rate of return method. That is a method where the management of a company will set a specific rate of return. It's also usually called a required rate of return. What it means is if I want to buy a piece of machinery and I'll say, you know what, I'm not going to buy that piece of machinery unless I can earn 10% additional revenue from the purchase of that equipment. In other words, it'll make me 10% more efficient, and I'll be able to earn 10% more revenue. That 10% would be my minimum or internal rate of return. We'll talk about it. We'll talk about all of those things. So earlier I said a dollar today is worth more than a dollar tomorrow. And I said it's because it can be invested. When a dollar can be invested, it does this thing. It does this thing called earning interest. Interest is generated from the investment of money into a investment. Okay. think of a savings account or a checking account that has interest associated with it. A lot of times, banks will offer you a savings account with a certain percentage interest associated with it. So if you invest $1 into your savings account, the bank will say, "Oh, you can earn, let's see, 0.2% uh, return, or yeah, 0.2% return." What does that mean? It means that you might be able to earn 0.002 cents on every dollar. And so the more dollars you have, obviously, the more interest you'll accrue over time. And that is the time value of money concept. You invest money today, and the money grows over time in the savings account because it's earning interest. And that is, the fundamentals of investing, right? All right, so let's talk about, we'll talk about present value, and we'll talk about first we'll talk about the two methods that do not use present value. Okay. Present value, again, is the value of money today, right? That's present value. I'm going to talk about two methods of investing that do not use present value. Uh, these methods, they're typically used to evaluate two different proposals, two or more different proposals that have what we call a short useful life. For example, if I am looking to, if I'm looking to create a new product line, and I'm just testing it out. I'm going to sell a few of them for a couple of years just to try it out. That is a project that has a short useful life. Okay, it's only for a limited time, as they say. Uh, and so these two methods are helpful in determining those types of small useful life projects. Okay, so um, let's take a look at these two methods and how we use them to evaluate different projects or proposals. A proposal is, oh, option one is we're going to repair this piece of equipment. Option two is we're going to replace this piece of equipment. Or a proposal, oh, we're going to buy product or equipment X versus equipment Y, right? Two different proposals. I'll show you a couple of examples. So the first of the two methods that do not use net present value is called the average rate of return. We typically just call this rate of return, okay, accounting rate of return. And what this average rate of return tells us, pardon me, I drink some water. What this rate of return tells us is the amount of return I expect to generate based off of an investment decision. So the formula for the average rate of return is average annual income divided by average investment. Average annual income divided by average investment. How do we find average annual income, you might be asking? Average annual income is the average income over a series of accounting periods. So for example, if in year one, if my income was 25,000, year two, my income was 30,000. Year three, my income was 35,000. If I add those 3 years together and divide by 3, that gives me my average annual income of 30,000. To find the average investment is the, how do I want to put this? Average investment is like saying, um, the average cost of a piece of machinery. Now, how do we find the average cost or average investment of a piece of machinery? We use this thing called straight line depreciation, which I'm sure you all remember that from a long time ago. Probably from, what was that 201, I think? We talked about straight line depreciation. Or, yeah, that sounds about right. No, maybe it was 202 earlier on. So we talked about this thing called straight line depreciation. You probably remember, well, you hopefully remember the example I gave a long time ago. It's on the purchase of a dump truck. Cost 25,000, average useful life 5 years. You remember that? That's how we calculated straight line depreciation. We take the cost plus residual value divided by the number of years useful life. Uh, we use a very similar approach to calculating the average investment. We take the initial cost of the machine plus any residual value divided by 2. And you all remember residual value means what is it worth at the end of its useful life? So let's look at it through an example. We're looking at purchasing a new piece of machinery. The cost of the machine is 500,000. Residual value of 0. The expected total income from the machine is 200,000, and its useful life is 4 years. Okay, so as you recall, the formula for the rate of return, average annual income divided by average investment. Here's how it works. Well, first, we've got to figure out what is average investment. It's the initial cost plus residual value divided by 2. Give me the average of the investment. So 500,000 plus 0 residual divided by 2 is 250,000. Now we take now I find the average rate of return. To find the average rate of return, it's the average annual income divided by 250,000. Our average annual income is 50,000. Well, I hear you. I hear you. You're saying, what, Dr. B, you just told us that the income was 200,000. What do you mean? It says average annual income 50. Now let's go back to our data. Okay. You see here, it says the expected total income from the machine is 200,000. If its expected useful life is 4 years, you take the total income from the machine divided by the expected useful life. 200,000 divided by 4 is 50,000. So we have our average annual income, 50,000, divided by our average investment, 250,000, equals an average rate of return of 20%, which, by the way, is pretty good. That's very good, in fact. We compare this 20% to management's minimum required rate of return. Earlier I had said we have what we call an internal rate of return, or also known as a minimum required rate of return. What that is management says, listen, any project that, or if I'm going to invest in this type of project, I need a minimum of X percentage in order to make it worth my time, right? So it's kind of like saying, it's kind of like a banker saying, hey, listen, I'm not going to give you the money unless I get X percentage as a return. Or let's say you're starting a catering business and you have a friend who's like, I really like you and I think you're doing a great job with your catering business. I want to invest in your business. But if I make an investment by giving you X number of dollars, I want a return of X percent, 10%, whatever, right? And that's off of your sales, right? And so from that perspective, in this example or in this concept of required rate of average rate of return, we compare that average rate of return with management's minimum or required internal rate of return. And the average rate of return should be equal or exceed the minimum rate. In an ideal situation, right? If it's less than the minimum rate, management will not accept the proposal. If it is greater than or equal to the required minimum rate of return, then of course, management would make the decision to accept the proposal. In this case, it's purchasing a piece of machinery. That's kind of how that works. Advantage is it's very easy to compute. That is a very simple formula. It includes the entire amount of income projected over the life of the project. And it helps other investors to determine the company's performance based off the return. Disadvantage is it doesn't consider cash flows. And it does not consider the time of those cash flows. Cash flows, as you know, is the cash we receive from our customers minus the cash we're using to pay our bills equals net cash flow. Hopefully you all remember that from a very earlier chapter. I think we were talking about the statement of cash flow. So that would have been Principles Accounting 1. So in understanding the statement of cash flows, you have cash coming in and cash going out for operating activities, investing activities, and financing activities. And based on those cash flows, we have this thing called net cash flow. So your cash inflow minus your cash outflow equals your net cash flow. And the average rate of return does not take that into consideration, which is one of the big disadvantages of this particular method. Any questions on average rate of return before we move on to the next method? We're good? Okay. Next method is called the cash payback period. Very simple concept. What this is it tells us how long before I recover my initial cost of the investment. It's that simple. How long is it going to take for me to recover the initial cost of my investment? To calculate this, we take the initial cost of the investment divided by the annual net cash inflow. Annual net cash inflow. Remember, when we talk about net cash flow, we're talking about net cash inflow, hopefully inflow. Otherwise, we've got other problems. Okay, let's take a look at this through an example. Cost of a machine, 200,000. Cash revenues from the machine per year, 50,000. Expenses per year, including depreciation, 30,000. Depreciation per year is 20. Okay, so let's take a look. Here we go. Here's how it looks. So we have revenue, 50,000, minus our machine expenses, 10,000. Oh, you're like, oh, Dr. B, what do you mean it's 10,000? I didn't see that part. I didn't see that part. Okay. So how did we get expenses? 10,000. The expenses of the machine per year, including depreciation, is 30,000. We know that depreciation is not cash, right? So we don't want to include depreciation in the expense. So if it says expenses of the machine per year is 30,000, including depreciation, we just simply subtract the depreciation out of that to get 10,000. So 30,000 minus 20,000 is 10,000. That gives us a net cash inflow per year of 40,000. Revenue, cash coming in, minus cash going out, expenses, equals cash inflow per year, 40,000. Okay, we got that amount. We good? All right. So let's plug our data into our formula. The initial cost of the machine, 200,000, divided by annual net cash inflow, 40,000, equals 5 years. What this means is that I will recover the initial cost of my investment within 5 years. That's how cash payback period works. It tells us how long it's going to take for us to recover our initial cost of the investment. Now, the example I just gave you is very simple. It assumes that every year for 5 years, I'm only going to make $40,000 a year. We know that business doesn't work that way, right? My revenues are typically never the same every year. They're usually different. So the example I gave you is very straightforward. If you want to calculate the cash payback period for a series of net cash inflows, we would simply go through each year, adding it to the last until we reach the time period in which the total cost of the investment equals the cash inflow. That's when we would have recovered the initial cost for our investment. So looking at it through this example, we see, keep in mind the initial, this is a new example, okay? Initial cost, 400,000. And here are my cash flows. First year was 60, second year was 140, third year was 245, fourth year 400. My net cash, my cash flow here's my yearly cash each year. First year 60,000, second year 80,000, third year 105, fourth year 155. I add these 4 years together, and by the end of that fourth year, I have reached my payback period. In other words, looking at this example, I'm adding up my net cash flows each year until I reach the point that I recover my initial investment. Make sense? This one's pretty straightforward, yes? Okay, so at the end of year four, I recovered the 400,000, so the payback period is 4 years. Nice thing is with this method, it's easy. Uh, a shorter payback period is most desirable, obviously. The quicker I can recover my initial investment, the better. That's what that tells me. Because I can use that money to invest on other projects, less of a chance of losing that money later on. And if you did take out a loan or equity to purchase that piece of machinery, you can quickly repay those investors or the bank at a quicker rate, which in the long run is good because it means you paid them less interest. Advantages, very simple, easy to use, and it analyzes cash flows. Disadvantages, after you have made your original recovery of the initial investment, we no longer take cash flow into consideration. I mean, you can make a whole lot of profit after after that initial payback period, but we don't take into consideration anything thereafter. And it does not use present value concepts with cash flows. So those are some disadvantages. Overall, cash payback period is a great way for you to decide on larger purchases that are relatively short in duration. So if you're like, oh, um, let's say you want to buy a piece of machinery, or you want to buy a cooler you want to buy a cooler um, for your catering business, and you're like, oh, I don't know if I could afford this cooler, or oh, I don't know how quickly I can get my initial investment back. You can run the cash payback method to be able to find that. And, of course, the shorter the better, right? You don't want too much investment just floating out there. Okay, so let's talk about present value methods. Earlier I said present value is value of the money today, and it takes into consideration timing of what will be received in the future. When we talk about present value, we're talking, of course, about evaluating an investment today and what it will look like in the future. That's the concept of present value. This method, we'll talk a little bit about it first, and then I'll bring up a couple of key points I want you to know. So present value of an amount, present value of an annuity are the two formulas. They utilize net present value and this thing called the internal rate of return. Net present value, value of the investment today, value of the money today. Internal rate of return, that is the required minimum rate of return set by management uh, based off of the investment. Here's what I want you to kind of take away from this conversation we're about to have. When we talk about the present value of an annuity, remember that an annuity is a regular payment made to you or by you. In other words, a mortgage is a form of an annuity payment that you make to the bank. A Social Security is a form of an annuity that you collect from the government. A pension payment is something that you collect from your employer when you retire. A 401k regular distribution is also an annuity that you collect regularly, monthly. That's what an annuity is. And by looking at these calculations, we can figure out how much you need to invest today in order to get a certain amount each month in the future. So that's why this concept is kind of important for your daily life. Okay, especially as you're thinking about, retirement, saving for retirement, that type of thing. Hopefully you guys talk about this in your personal finance class. It's really important concepts. Okay, for those of you who haven't gone through it, hopefully you do cover that concept. So let's look at it in very simple terms from a dollar. Let's say you invested a dollar, okay, or you're looking to invest a dollar, and you're going to leave that dollar in the bank for 3 years. It has an interest rate of 12%. This is the long math, okay? I'm going to show you this thing called compounding interest. So the 12% is yearly. You invest a dollar today. At the end of that first year, your $1 earned 12 cents. How do we know that? 12% of $1 is 12 cents. Okay? So now at the end of that first year, you have $1.12. You leave that $1.12 in the bank. That during the second year, you earn another 12%. At this point, we're saying you're earning interest on interest plus your initial principal. So you have $1.12 at the beginning of the second year. You let that $1.12 sit in the bank account for a full year. 12% time, I'm sorry, $1.12 times 12% will get you another 13 cents in interest. So at the end of the second year, you'll have $1.25. Now we leave that $1.25 in the bank, and at the beginning of third year, you have $1.25. You leave that $1.25 in the bank for a year at 12% interest. At the end of the third year, you'll have $1.40 in the bank. What this process is called is compounding interest. It's where your interest earnings earns interest. In other words, your money is making more money, is making more money. Or also another way to say it is you're earning interest on top of interest. Make sense? It's a very important concept. I want to make sure that you all understand. Andre,
It,
is it good?
yeah,
Is it clear?
it makes sense, Professor. It's
Perfect.
just that it's a very small value for the end of a third year.
It is. It's only 12%. We're only talking about a dollar. Now, Andre, if you think about it, the more that you would invest, and in terms of principal cash, the higher your return is going to ultimately be. 12% return is huge. That's a lot, on any investment. That's a lot. 12%.
I think normally I've seen like maybe like 4 or 6% when it comes to like returns. I think, especially if you're doing like a
Yeah.
401k.
Yeah, that's about right. When you're doing 401k investing, or you're just simply saving for retirement in mutual funds or some other type of investment vehicle, uh, well, I mean, Andre, technically it should be higher because the S&P 500, which is an index of the largest 500 companies in the United States, uh, well, thereabouts. It's a cross section of companies in the United States, Fortune 500. The Fortune 500 average return throughout the past 3 years has been averaging about between 6 and 8%, which is, well, this past year is like 10%, or 2 years ago was about 10%, which is high. Uh, if is if your retirement portfolio, um, you should be matching or outperforming the S&P 500. So, but that's for another discussion for another day. But it's a good concept, and it's important to understand this concept because as you invest, as you save, as you do whatever you do, um, it's important that you understand how compounding interest works. This is just a nice graphical representation of what we just talked about. A dollar times 12%, $1.12 times 12%, $1.25 times 12%. Then in the third year, we got $1.40. Just imagine what it would be if it was $100 that you put in at 12%. We're talking, what, $140. That's a big difference. So it's important that you understand the concept. So at the end of the third year, $1.40 received. What does it mean? Well, the initial investment was $1. We received 40 cents interest over 3 years. There is another way to find how much uh, how much you would receive in addition to your principal at the end of a year. So it's called an index table. So instead of, computing it out with your calculator, there's another way of finding it. It's called an index table. An index table, this is an index table. An index table shows us the, how am I going to put this? The index table shows us the present value of that dollar expressed as the number of years and at which percentage. We can see that based off of this type of index table, with less years and less percentage, we have a higher yield. We'll talk about it. It gets a little interesting, but we can see what the value of the index does. And let's take a look at it from this perspective. So at the end of the third year, we had $1.40 in our account. If I use the index table, so 3 years at 12%, it's 0.712. I take 0.712 and I multiply that by the value at the end of my third year, I get back to $1 as being the present value. So in other words, we can use this index table to understand what the original investment was, or you can also use this to understand how much you need to invest in present value terms in order to generate X amount in interest. And the nice thing is with these tables, it's as simple as going across. It's like, oh, year, amount, right? Very straightforward. Let's talk about annuities. Annuities, as I said earlier, is mortgage payment. It is Social Security payment to you. It is. It could be your rent. It could be salary. It could be bond interest. These are all examples of annuity. When you hear annuity, think regularly scheduled payments. Regularly scheduled payments, and they're all the same amount. Okay. So salary, rent, bond interest, mortgage payment, car payment, these are all annuities. And annuities are regular, they happen at the same time each month, and they're the same amount. that makes it an annuity. It has to be more than one to be called an annuity. Actually, it's got to be more than 12. The present value of an annuity, we call this present value of an annuity. The way to think about this is it's the amount we need today in order to yield a series of equal payments in the future. This is where it gets important. For those of you who are looking to retire in the future, at any time in the future, you need to understand how much you need to have to invest today in order to retire with X amount each month in the future. Because we know that in retirement, you live off of a fixed income. So, present value of a $100 annuity for 5 years at 12% is determined by the present value factors. $100 net cash flow multiplied by the value of a dollar at 12% gets us a present value of $360.50. What does that mean? I need to invest $360.50 today in order to receive equal payments of $100 for a total of 5 years. How do we find this? In year one, I need to invest $89.30. How did I figure this out? Well, I said I want to have $100 each year for 5 years. I take $100 times the amount we found in our table index, 0.893. 0.893 times 100 is $89.30. So for the first year, if I put $89.30 into the bank, eventually I'll be able to get $100 out of the bank. In the second year, I need to put in $79.70. Again, $100 times the index for year two. Year three, $71.20. $100 times the index for year three. Year four, $63.60. $100 times the index for year four. Year five, $56.70. $100 times the index for year five. What this does is it tells us how much we need to invest today in order to receive equal payments of $100 for a series of 5 years. So let's take a look at the index table. So here's the index table. We said the interest rate was 12% for a total of 5 years, okay? So 12% year one, 12% year two, 12% year three, 12% year four, 12% year five. I take 12% year five, 12% year five times the initial, times the $100 return that I want for my annuity, gets me to how much I need to invest today in order to earn consecutively annuity payments for 5 years. And what that shows us is we invest $360.50 today to earn $100 per year for 5 years based off of a 12% return. Again, it's a helpful concept for when you're ready to retire, or before, obviously way before you retire. It tells us how much you need to be investing in order to yield a particular return through annuities. And when we talk about interest rates 12%, okay, that's a little high. You know, realistically, it's a little high. But I would always plan for about 8% as being an actual return rate. And so hopefully that concept is helpful for you when you do get ready for retirement, at least in retirement planning. The net present value index, which is that index table I showed you earlier. We can use this in a couple of different ways. We typically use it in combination to understand, of course, percentage and what we need to invest. Present value method. Let's talk about the net present value. Net present value, as I said earlier, is the sum of all of the present values over a series of time. We sometimes call this method the discount cash flow method because we work backward, and I'll show you how that works. The interest rate, which is also called a return, is used in net present value to analyze what we called earlier the company's minimum internal rate of return. The minimum internal rate of return, also known as the desired rate of return, also known as a hurdle rate, also known as, right? Basically what it tells us is how much the company wants to receive from the return of their initial investment, what they expect to get back, right? If the present value of cash inflows are equal or greater than the original investment amount, then of course it's desirable. Makes sense. Basically anything above zero is what we're looking for. So let's take a look at an example. The company's looking to purchase a new piece of equipment for $200,000. The expected useful life of the equipment is 5 years. The minimum desired rate of return, or minimum internal rate of return, is 10%. The expected cash flows for each year: year 1, 70,000, year 2, 60,000, year 3, 50,000, years 4 and 5, 40,000, for a total expected cash flows of 260,000 over the course of 5 years. Now, okay, sure, we can already see that's probably worth it, but let's figure out how it's worth it. So, what do? We take the internal rate of return 10%. We take the present value using the index table times the net cash flow for each year equals the present value of the net cash flow. So present value at the index times the net cash flow equals present value of the net cash flow. So we go through we do the same thing for each of the 5 years. We add up all of the net cash flows for the 5 years to get to 260,000. The present value of the cash flows, we add those up for the 5 years to get 202,900. The original investment of the equipment is 200,000. You take your total net present value of cash flows, 202,900, minus the initial investment of 200,000, equals a net present value of 2,900. Would you do this deal or not? The answer is absolutely. I mean, it's the present value return is higher than the initial investment. So yes, absolutely. This shows it graphically again, just as it has we did earlier. You take the net cash flow for each year, multiply that by the value index from the table to get your present value for each year. We find that the 202,000, if you've added up each of the net present values for each year, 202,900 minus the initial investment gets you a net present value of 2,900. And since, of course, it's higher than the initial investment and it satisfies the 10% rate of return, if it is desirable, you do the deal all day. Advantages to this method: it considers cash flows. It considers time value of money. And you can use this to rank projects. What does it mean to rank projects? So if you have more than one investment opportunity, like, oh, piece of equipment X versus piece of equipment Y versus piece of equipment Z, you run out those projections of cash flows, you use the index table, you can say, oh, this one will yield me this one will yield me this one will yield me this. You can rank them, right? It's like, oh, this is the best one, this is next best, this is the worst. And that helps management make decisions on which piece of equipment they should invest in. There's some disadvantages. It's difficult to do, right? That's probably the most difficult computation. And it assumes that cash flows can be reinvested, which sometimes it's not always true. So you might be wondering, um, present value. Oh, you know what? Before we get into it, well, here's a good place to tell my story. After we talked about we we talked about that. So, did I ever tell you guys the story about the chiller at the hotel? I did, didn't I? I must have told you that story at least once. Do you remember? Did I tell you guys that story?
I heard it twice.
You heard it twice. That sounds
Yes, sir.
that sounds like me. Okay, so real quick, Angela, let's hear it a third time. Years ago, I was a financial controller at a hotel. The chief engineer comes to me and says, you know, the chiller on the roof just it's ready to break. I said, okay. Um, well, is it in the budget? No. Okay. Well, how much is it going to cost? A lot. You know, he told me the amount. I forgot how much exactly it was. It was ridiculous, though. It was in the multi-millions, multi-millions, like tens of millions. Yeah, very expensive piece of machine. So then we did the good old question: replace or repair? So, okay, well, what if we repair it? How long will it last? 6 months, maybe a year, maybe 2 years, maybe 3 years. Okay, great. How long will a new one last? At least 10 years. Okay, great. So we run out the total cost. We look at the initial cost of the investment, any residual value divided by useful life. We look at all of the estimated cash flows for future years to figure out, is the investment worth it? And we ran the net present value calculations. We compared it to the internal rate of return. Ultimately, we ended up deciding to go with a new chiller. So all that to say, these types of formulas, these types of methods, they are used. They are used in accounting. They are used on a regular basis in a lot of different scenarios. So don't be surprised if one day you find yourself in a situation where you either own a business or you're an investor or you're involved somehow in the decision-making process or whatever, that you have to kind of think about these types of methods of computing the investment to make sure that it's worth it. You can even do similar types of things for your personal investments as well. Just think of yourself as a business. Oh, your income is X. Think of it as business income. Oh, the investment of the tool is Y. Okay, that's so. But you see where I'm going with that is that you can find ways to use these concepts. You can apply it both to business and to your personal life. No. All right. So when funds are limited, which is what made me think of that story. When funds are limited and the proposals can involve different investments, we can rank them using the present value index. You take this to calculate present value index, we take the total present value of net cash flow divided by the amount to be invested. Earlier in our example, the total present value of the piece of machinery that we were looking at purchasing 202,900 divided by the initial investment, 200,000. This gives us a present value index of 1.0145. Now, why is this number relevant, you might be asking? We can rank the proposal based off of that number. That number can be compared to other possibilities. So let's look at it from another example. We have a company here looking to at 3 different pieces of machinery to possibly purchase, and we have 3 different possibilities for net cash flow, which means we're going to have different net present values. So let's take a look. Cash flow proposal A, 107,000. Piece of machinery, 100,000, giving us net present value of 7,000. Proposal B, net cash flow, 86,400. Initial investment, 80,000. Net present value, 6,400. Proposal C, 86,400. Initial investment, 90,000. Net present value, 3,600. Now, I'm going to ask you all the questions, and I'd like you to respond by telling me why. Here we go. If you were making this decision, which proposal would you select and why? Who wants to go? Giovanni. Giovanni, you there? Want to answer the question?
Yeah, I think I will do proposal B
Proposal B, that's a good option. Now, why would you select proposal B?
because there is 1.08 the
Yeah.
index value at the end.
Yep, that's the correct reason. Absolutely. The higher the index value, the better. Earlier we had said the index value is used for ranking different investment proposals. So 1.08 has the highest index value, but it does not have the highest net present value. When we take into consideration the index, we're only looking at the present value of net cash flows divided by the initial investment. So based on that perspective, proposal B would be the best option. It's not always based off of the highest net present value. Proposal A, it's a good proposal, but it's not going to yield as much as proposal B would. So proposal B is the best decision here. And the reason why is because proposal B initial investment 80,000, proposal A initial investment 100,000. If we are comparing the two based off of the initial investment, we can see that the return is, the difference is 1 cent, right, in terms of the return, but proposal B is 1 cent higher per dollar. Proposal C, we wouldn't even consider because, first of all, it's below 1. When the index is below 1, we automatically reject it. That's what that does. Okay, very cool. Now, another interesting finance concept called the internal rate of return. Internal rate of return. We I've mentioned the internal rate of return before. Management sets internal rate of return based off of what management wants to see based off the investment. Internal rate of return, we compare it from one proposal to another, and we utilize it based off of the expected net cash flows. We call it sometimes the time adjusted rate. Yeah, once in a while we call it that, I guess. I think of it as the expected rate of return or internal rate of return. That's what management says. This is my minimum. Yep. Okay, so here we go. Here's an example. Cost of new piece of equipment, $33,530. Yearly expected cash flow, $10,000 a year. Expected useful life, 5 years. Minimum desired rate of return, 12%. Here's how the formula works. Annual net cash flows at the end of each of the 5 years, 10,000, times the present value factor of an annuity found on the chart. So 12%, dollar, 5 years, 3.605. 10,000 times 3.605 equals a present value of annual net cash flows, $36,050, minus the initial investment of the machinery, $33,530, equals net present value, $3,520. Okay, so the present value we found is based off 12%. It's greater than the initial investment. So 36,050, which was the present value of the net cash inflows, is greater than the initial cost of the initial investment, 33,530 for the machinery. And it's based off the 12%. So that means, because 36,050 is greater than 33,530, that means the return is greater than 12%. We can calculate that out to find out the exact return. So the exact return is 15%. How we got that, we've looked at the return, 33,530, with the present value on the index. So based on that, 5 years, $10,000 per year, the amount per year times the value on the index will yield the break-even. Fun stuff. Okay. Couple of steps. When net cash flow is equal to the internal rate of return, couple of steps here. Step one, we find the present value of annuity for $1. So it's the amount to be invested divided by the equal annual net cash flows. Step two, we use our chart, our index. We use our index, find the number of years, find the number of years, find the percentage, come across to find the index amount. Step three, figure out what the internal rate of return is across the top column. Okay, let's look at an example. Cost of a new piece of equipment, $97,360. The expected yearly cash flow, $20,000. Expected useful life, 7 years. I used my chart, my index. 10% return, 7 years, 4.868 on the index. So 97,360 divided by the annual net cash inflow, 20,000, equals the index amount, 4.868. Advantages of this method, it's pretty straightforward. Considers time value of money. We use it to rank proposals over time. Disadvantages, it's very difficult to compute, especially when cash flows are not equal. And it assumes that we can reinvest money over time, which is not always true. Okay. In management, we look at a number of different factors when making capital investment decisions. The lease versus buy, rent versus own, right? Lease versus buy, make versus buy. Proposals with unequal lives, qualitative factors, changes in price levels, changes in customer behavior, uncertainty, income tax impacts, all of these things and a few more impact our capital investment decisions. Sometimes I might avoid certain decisions if it has a negative impact on taxes. For example, we know that the more the company makes in terms of profit, the more the company has to pay in taxes. What oftentimes companies will do is they will make capital investment decisions to reduce their tax liability because as we make investments, meaning we're growing the company by doing other activities, purchasing some land, some equipment, some machinery, a building, whatever, right? The more of that stuff we do, it lowers our impact on taxes because I can, well, I don't want to use the word write-off, but we can reduce our tax liability by using our funds in a way that is financially better, I guess. A company that's notorious for this would be Amazon, continually investing in property, plant, and equipment to reduce their tax liability, which is why they haven't really paid a lot of federal income tax over their existence. I'm not saying they haven't paid any. They definitely paid, but you know they could pay more if they weren't investing so much in their property, plant, and equipment. Unequal proposals. Sometimes we make an investment decision. That investment decision changes over time. It has an impact on the company. Here's an example. Let's say a company's looking to purchase a new dump truck or a computer network. These are two totally different decisions, two totally different things. Okay? The dump truck is going to last longer than a computer network, I think. I hope. Here's some data. The truck costs $100,000. Computer network also $100,000. Company's minimum rate of return is 10%. The expected useful life, here's where the difference comes into play. Okay? 8 years for the truck, 5 years for the computer network. Expected cash inflows. We can see that, you know, of course they're going to be the same. It's the same company, right? At the end of year 5, in years 6 through 8, the dump truck continues, right? 15, 10, 10, up, 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 up. We see that we had to put, you know, computer network, of course, it's going to be 0 past year 5 because the useful life is 5 years. For the truck, it's 8 years. 8 years spread over time. We look at the difference between the two, and it's difficult to get the same net present value, even with the same amounts. And the reason for that is when the useful life for property, plant, and equipment, different investments, same amount, whatever, when the useful life is different, it's going to have a major impact on net present value. And so therefore, it's difficult to compute two different investments with different useful lives. The good old lease versus buy. Remember, lease is like renting, right? And then buying is like buying. So when you're leasing something, you're expensing it out, right? Yeah, you take on less risk, but your maintenance costs will be a lot lower, but the overall payments are probably going to be higher, and you can't deduct some things for taxes. You can deduct some, I guess. So that's good. But bad things about it is that with leasing, it's usually higher cost than purchasing the asset. So it's sometimes those decisions can be difficult to make. Uncertainty, well, no kidding. I mean, that goes without saying, right? Uncertainty in investing decisions relies on factors that are uncertain. Revenues, expenses, cash flows, all of these things change on a regular basis, and sometimes it can be uncertain. Sometimes you get hit with a pandemic, and all of a sudden you have to shut down your store. It's like, oh, okay, well, I can't sell, so my revenues unexpectedly went to zero, but yet I still have fixed expenses that I still have to pay. So, which obviously has impacts on cash flow. So that type of uncertainty has influences capital investment decisions. Changes in price levels, the economy goes up and down, therefore prices go up and down with this thing called inflation, which we're starting to experience again, even in today's day and age. The government prints more money, it raises inflation. Government prints more money, it raises inflation. They spend more, it raises inflation. Up to the point where, the cost of everything goes up. That's what we're seeing today. During these times, with rising price levels, it causes the internal rate of returns to change for capital investment decisions. And we know that can be dangerous. Another thing that changes, especially for multinational corporations, is currency exchange rates. So, Coca-Cola, they're a major manufacturer of Pepsi. Coca-Cola's large manufacturer of soft drink products throughout the world. They operate in multiple countries. They oftentimes have to deal with currency exchange rates because it's a U.S. company operating in different countries. And so because of that, when the value of the US dollar changes, it also changes the local currency that is related to the US dollar. And that's why each country has their own monetary value system. And so when there are differences, it can have negative impacts on investment decisions. Qualitative considerations, product quality, manufacturing flexibility, employee morale, manufacturing productivity, market segment opportunities. When there are changes in these types of things, it will result in changes in capital investment decisions. Something called capital rationing is very common practice in business. It means exactly as it sounds. Companies will go into what we call conserve mode. They will not make capital investment decisions when times are risky. When there's too much risk, they won't make decisions. When there are survival concerns, they won't make decisions. And so what that does is it also changes the ranking process and how funds become available and things like that. So that's one concept of it. So this is a long slide to basically say when funds are available, we make investment decisions based, and we go through the ranking process. When funds are not available, it gets rejected. Very simple. Sensitivity analysis. Sensitivity to the marketplace, to investing. Sensitivity is based off of the company's ability to take on risk. Risk is inherent with any type of investing. It is, there's always the opportunity for risk to come about. Some companies are willing to take on a lot of risk more than others. Some investment decisions are more risky than others. And so those types of risks help management to set their understanding of revenues, expenses, cash flows, useful life, desired rate of return, and residual value of investments. So sometimes the risk means losing the entire investment. So let's take a look at sensitivity analysis from an example. Cost of equipment, $2.5 million. Residual value, 100,000. Annual cash inflows, 600,000. Useful life, 8 years. Desired rate of return, 15%. So if we go through, find the net present value. Net present value, 224,900. If looking at the present value factor, if it's above 15% for 8 years, and we do the deal. Given the fact that the net present value is positive, indicates that it's a good investment. However, let's say something happens. All of a sudden, I was making 600,000, then something happened. Now I'm only making 500,000. Or, now I'm only making 400,000 per year. We see what this does to the present value. There are substantial impacts. Some good, some not so good, right? And so these types of uncertainties or sensitivities has a direct impact on management's decision based off of not cash present values, not cash flows. So what that tells me is, as things shift when it comes to sensitivity, we see that the opportunity for the investment also needs to change. So if I have an increase or decrease in cash flows, the decision to make that initial investment changes as well. So earlier we assumed annual net cash flow is 600,000. If it actually comes in at 549,000 or greater, then we say let's do the deal. Anything less than 549,000 is probably not going to be worth it, because it means the present value is coming below 1. That brings us to probabilities through expected value analysis, which means is it probable or not. Probability, hopefully you covered this in your statistics class. If you had a statistics class, hopefully you did. It means what is the likelihood of something happening or not. You can identify probability based off of something happening. So 70% chance I'll make 600,000, 20% chance I'll make 500,000, 10% chance I'll make 400,000. The probability of something happening. We can take a look at the annual cash flows times the probability of it actually occurring to find its expected value. The expected value helps us to understand what we anticipate actually getting, right? Expected values will help us to determine the net present value and the net present value of making the purchasing decision for a piece of equipment. So, just as we've done before. So by assuming probabilities, it helps us to identify outcomes of uncertainty. What's the likelihood of something happening? Okay. That was in chapter 26, if you could believe it. Actually, we got through that pretty quick. That's about right. That's 6:30. I did expect it would be about an hour and a half. Okay, comments, questions, concerns, anything at all? Anything at all? We got 1 week left. How do we feel about that?
Professor?
No, go ahead. Yeah, go ahead, buddy.
Is there any way you can send me a link to the updated version of the book, like the newer edition?
You should have it. So the newer edition is the. Hey, you should have it. When you log into the classroom, this version of the book, you click on textbook, and it takes you to the classroom, or to the. If you click on textbook and you click on that first link, it should take you to that, where the assignments are. If you click on study tools and go to ebook, that should be the version.
Okay.
Should be. Oh, maybe not. Maybe not.
Yeah, that's
the
the
version. Yes, this is the old version. Uh, so what happened is, what the drone's getting at is, um, this newer version is the 15th edition. You're using the 14th edition. Uh, what we just covered, which is capital investment analysis, that is the same as your chapter 25.
Oh, okay.
Yeah, so it's off by one number, basically. It's because what happened is that the publisher turned this chapter into two different chapters.
So what about 27 and 28? Would that be covered in 26?
Yes. So 27 and 28, let's just double check. 27 is, yep, lean manufacturing, which is covered in chapter 26. And 28 is also, I believe, in 26. That's activity analysis.
Okay.
It's just broken
Thank
down.
you.
Yeah, for some reason, the new, well, you know how it is. These publishers, every year, they change it up slightly.
hmm
And so that's all they did, is they divided those last two chapters into two additional. So, good point. Thanks for bringing that up.
No problem. Thank you. Appreciate it.
Hey, my pleasure. Any other comments, questions, concerns, anything at all?
I have just one question.
Tamika? Yep.
Are you doing any classes in the summer?
Yes, I'm teaching Principles of Accounting 1 again in the summer. So the one before this in the summer. And then in the fall, I think we're just doing Principles 1 and 2 again. Are you an accounting major, Tamika?
Yeah.
You are. Yeah, do me a favor. You know Professor King?
No.
No? Okay. Send me an email. Let me know which courses you're looking to take next for accounting.
Okay.
Okay. And then from there, I'll talk to Professor King. Professor King is in charge of the business programs for the community college. So
Okay.
I'll talk to him about the offerings.
Okay.
Yeah, great question. What I do know is that, Tamika, for your other accounting courses, most of them will be at Van Ness.
Oh, okay. Thank you.
Because they're offered through the School of Business and Public Administration. Good question. Any other comments, questions, concerns at all? Also note what's going on this week. I will be looking at your discussion board responses. I'll take care of the grading for those here in the next few days. Probably by Wednesday I'll have that done. For this week, you have your quiz for chapter 26. If you are one of those few that love to work ahead, please feel free to do so. Week 15 is open and available. You could go through, read 27, 28, homework 27, discussion 28. You can see that we have a few people already participating in chapter 28 discussion. And the final exam. The final exam is also open and available if you want to go ahead and start it. You can start, you can save it, just don't submit it until you're ready, okay? The final exam covers chapters, the second half of the course, right? So correct me if I'm wrong, I believe the midterm covered through chapter 21. So that means chapters 22 through 28 are covered on the final exam. The final exam is worth 20% of your total grade. There are 20 total questions on the final exam. You can only attempt it once. Please take your time. It's open book. It's open note. Take your time answering the questions, please. You can, again, it's open and available. So if you want to start now, you're more than welcome to. Just remember, take your time. It covers chapters 22 through 28. Any other comments, questions, concerns before we call it a night? No? Okay. Well, again, thank you all so very much for your time today. I hope that this was a helpful conversation. If you think of anything, need anything, shoot me an email, call me, set up office hours with me. You know how to get a hold of me. Other than that, stay safe, wash your hands, and have a wonderful evening. Thank you all so very much. Take care now.
Thank you,
Thank you,
Professor. Have a good
Professor.
day.
Have a great weekend.
Thank
Thank
you.
you, Professor.
Take
Thank you,
care.
Professor.
Take care, y'all. Always a pleasure. Thank you so much.